Mhm.
All right. Okay, it is July 12th?
July 12th.
July 12th, 2021. Welcome to Trading with Rich. Today, my brother-in-law, Pat here, one of my best friends, is walking with us. We're going to actually walk and show you a little bit of Chicago before we leave.
Or at least Aurora.
Yeah. And when I say leave, I use that word very loosely. As you saw on the Every Man Has a Story, I was supposed to leave on July 19th. Just got told today that that's been canceled again. Yeah. Taiwan has extended their travel ban through July 26th. So all flights on EVA Air have been canceled that were going to lay over in Taiwan.
I think they're just trying.
And I had these tickets to go to the Philippines. I really wanted to go, so I made sure I got my vaccine as soon as it was available. A lot of good that's done me. I'm still not over there, but I've been vaccinated since March. So today we're going to discuss stocks a little bit. You may have watched one of the previous episodes when Pat was talking about wanting to, learn how to trade. And then I went on Every Man Has a Story and explained, what the Trading with Rich channel is going to be about. And got a lot of responses from that. So people like Pat who really want to learn how to do this have responded, and I've had a lot of offers for people wanting me to trade for them, but that's not what this channel is about. This channel is about, it's a training and education channel. So today's topic is going to be leaps and full shares of stock.
So when we were talking last time, we were talking about the concepts of calls and puts, and we were talking about using stocks we own.
Mm-hmm.
Then I hear this term called leap, and I'm kind of mystified by it. I don't quite understand how that concept works.
Right. I think it's a lot riskier than owning a full share of stock, but it could cost you less than 50% of the original stock. So, in this game of trying to control the stock so that we can write premiums, do calls, it's very handy because you don't pay as much for it.
And I'm guessing this is something you do a little bit farther down the line when you've got some confidence, you've got some capital to work with to back yourself up. Okay.
Yeah, when you first get started, Pat plans on rolling over his 401k into an online brokerage and, basically renting out his stocks. I always recommend you start out by doing covered calls. So, the stocks you may have, either in your 401k or things you've picked out to work with, you'll actually rent those out by making an offer, doing an ask, and saying, hey, does anybody want to take an opportunity to buy this stock?
Right.
Sometime in the future, say 45 days out. And how you doing?
How you doing there?
Good. I have to keep avoiding these trees.
It's like the jungles in Manila. Well, wait a minute, there are no jungles in Manila.
No, but the jungles outside of our town there is Cagayan and Dioro. So think of it this way, Pat. It's just a big option. Whether you do an option and you buy a stock for 45 days and you write a call against that, every 2 weeks and maybe do 3 of them during that time period, or do a leap. Equity anticipation security, LEAPS, is defined as a publicly traded option with expiration dates that are longer than a year, typically up to 3 years. They function identical to most other listed options, except with longer times until expiration. So this is just like you bought a call option. It's just not for 2 or 3 weeks or a month. It could be up to 3 years. And the key thing to remember about LEAPS is it grants the buyer the right, but not the obligation, to purchase or sell the option, the underlying asset at the predetermined price on or before its expiration date. The cost of your premiums. Yeah, I usually find that my costs on my LEAPS are about 3%. So you've got to make some calls to cover your premium. Sometimes my premium may only be 1%, but at the high, it's 3%. If it goes higher than that, I don't buy the LEAP. Long time frame ties up investment dollars. Markets or company movements may be adverse, and that's a con. And price is more sensitive to changes. Long-term equity anticipation securities, LEAPs, calls. Now, this is called a poor man's call. Okay, so poor man's covered call actually is taking a premium on the call and matching it up with the LEAP. So equity, another name for stocks, which a LEAP is a call option, allows investors to benefit from potential rises in a specific stock while using less capital than purchasing shares with cash up front. I usually find that I can buy stock for buy a LEAP for about 30% to 60% of the original stock price. That's been my history. So to buy or sell the contract. I use Tastyworks out of Chicago. They charge me $1 for each contract, and they don't charge me anything to get out of the contract. Now, besides the dollar, the SEC charges a small percentage, usually, anywhere from 10 to 15 cents for the SEC charges. So it's not just $1 to Tastyworks, it's also a small SEC charge. A long-term equity. What's one of the main reasons why you might want to buy a LEAP? Well, you can lose less money. It does minimize your risk. So instead of paying $45.53, you're actually paying 60% of that. So you're paying $27. What if NEO were to crash and go to zero? Well, you would only lose the $27.31. You wouldn't lose the whole $45.53. So another reason you would want to buy a LEAP, like I implied earlier, was you would want to actually put calls on those LEAPs. So on these 5 here, I had calls that are coming up next Friday. I made $900 on that call. It's obviously not going to hit 55. It's only at 45 right now. But if it hits less than 55, then I collect all $900. So far, I could sell myself out of that obligation for $145 and profit $755. Okay, 1, 2, 3. All right, a LEAP is it's just an option that's been extended out, usually more than a year. Sometimes they're 2, maybe 3 years. And what you've done is you've actually said that, I would like the right, but not the obligation to buy this stock at the end of this expiration period for this particular price. And I'm willing to pay so much for it today. So that's the extrinsic value that you take on when you do a LEAP. So if I buy this stock for $100, full share, $100, I pay $100.
Right.
And if I own 100 of them, like, you're going to do one contract in the options market, and you're going to say, hey, if somebody wants to buy this for $110, I'll sell it to you with the premium of $2. Mm-hmm. They're actually going to need to get to 112 to break even, because that 10 on top of the 110 plus 2 would be 112. That's pretty simple to calculate, whether you win or lose, right? If you're the other guy and you're buying,
you own the stock.
Mm-hmm. What we do on our end with Trading with Rich is we're the bank. We actually make the bid. We are the ones we're the call writer. We're the ones that actually say,
and you have to know when to duck,
know when to avoid the trees. When you're the call writer, you've got all the cards, and you're laying them on a table and saying, does anybody want to play? And so in the long run, what you've done is you said, I will buy these shares for let's say they're going for 110 right now.
Right.
I'll buy these shares 2 years from now at $80. And in the meantime, you don't just pay the $20 difference right now. Mm-hmm. Today I buy this LEAP and I get it for $20. No, somebody on the other side is selling you that opportunity to buy this stock. So they may charge you $23.
Okay.
Okay, so you're actually buying the stock for about $103 instead of $100, but you get to keep it for 2 years. You with me so far?
And you keep it for 2 years, but 2 years from now, or sometime in that 2 years, you could buy that stock at $80 a share.
Any day you want it, you can buy it for $80.
But
you paid $103 for it.
But you paid $103.
Right.
So essentially, for you to make a profit, it has to go above $103 a share. Yes?
Correct.
No?
Yes.
Okay. All right.
Yes.
So
The Chinese car company. Go into trade, click on trade, and pick a date sometime in the future. Remember, the LEAP is a long expiration anticipated product, and here you can pick LEAPs that are 158 days out, 193 days out. You can pick one that's 2 years out. This one's about a year and a half out. That's the farthest out it goes. So let's go ahead and pick on January 20th of 2023. And at this point, right here, where it says out of the money, this is where the column at Tastyworks where you'd actually click on it and hit the delta. So what I'm looking for is to try to get the most control of the stock, which would be 94%. And I'd like to control 94% buy ownership of this long expiration anticipation product. I'd like to buy it for $15 in January, a couple years from now, 557 days. And if I include what I'm going to pay for it, which the bid is 30 and the ask is 34, to the 15, that's how much I am actually going to be paying for this product. So let's say 5 on 41, that's $46.50, and it's running $46.34 right now. So you are getting a little bit of a break, about a $5 break that you don't have to pay until next January. So look at it that way: pay this now, pay this later. Now, a lot of times, so pick something like that. This is the sell, this is the buy. I'm going to buy one for $21. And remember, that's $21 times 100, so that'd be $2,100. We always talk in single share prices when we're looking at making a bid or an ask. But anyway, $21. Right now, the order would be good till July 22nd. Today's the 12th. And if I wanted to place this order, I would just go ahead and hit send, and it would tell me that and I've only got about $1,800 in the account right now in cash. So it says you don't have enough money to buy this yet. Not a problem. We're just doing the example. 2100 debit is 21 times 100. And if the price winds up being less than $53, the maximum possible loss is $2,100. So you can only lose as much as you invest in a LEAP. So at this, I could lose $2,100. If I bought the stocks outright and paid $46.34 times 100, that'd be $4,634. So I actually could lose half as much if the stock went down to zero. So I'm actually only investing about 50% at the 80 mark. And if we wanted to actually run the calculator on that, it'd be very simple to do. Let's run the calculations on it. We are paying $2,100, and the original stock is $46.34 times 100, so that'd be $46.34. So we're actually only paying 45% of the original stock price, paying $2,100 instead of $4,600. Now I'm going to throw a little twist in on this. Okay, when you buy that stock out there for 2 years, you get to choose which delta you want. Now I'm going to really blow your mind now. There's a
Are
delta.
we talking like Nile or Mississippi?
No, this is
Okay. All right.
this is the delta, the difference between how much you control and how much you actually own. So when I
Okay.
buy these stocks out at 2 years, I like to go with 90% of control. That's about as high as these leaps will go. So for every dollar that it goes up,
Okay.
I get to keep 90% of that. But the other on the other side, they get to keep the 10. It works into the premium for the leap.
Okay. Now this is a concept that's totally foreign to me.
Yeah, this is how much a leap actually you know how much you pay for it at the day you bought it. So the lower the delta, the less you control that stock. The other person, has the other side of that. If you will go with a 50 delta is what they call it. It's the term in the stock market. If you go with a 50, you're probably only going to pay about 25-30% of that stock. So if you buy a $100 stock, you're probably only paying $30 for the opportunity to control that leap. But when the stock goes up, you don't make the full 100%, you make 50%.
Okay.
So if it goes up to 110, then you get $5. The other person gets the other 5.
Got it.
Okay.
So
So here's what's
and-
sweet about that.
Okay.
You get 100% control over that call. The one that you. Now, how would you sell a leap? Well, let's say we got something, like this down here, January 1st. We want to close the position. It would actually pull this up and say, well, you bought it for a certain price. Now you can sell it between 30 and 34. So you go out and make an offer. And so I'm going to sell this product for, say, $32.50. And it's 100 shares of stock that I control until January 20th, 557 days from now, at $15. So I actually own this at this point. Got control of it for another 557. I'm not going to get rid of this, but I'm just showing you an example of how you would sell it. You just go ahead and put the good to go date is till July 22nd. Place the order. Says that they would give you a credit of $3,250, and that would be a profit of $779. That is how you sell a leap.
Traditional, I shouldn't say traditional, but usually about how far out do you buy it? I know that varies. But
I like to
let's-
buy them out 2 years.
Okay, so 2 years. So now I got this option, this leap for 2 years. Now I'm going to write calls against that?
Right.
Okay, how does that work?
Well, once you own that 100 lot of shares, whether it be a leap or you just bought the stocks completely, you can write a call that says, I will sell this $100 stock to anybody for 110 in the next 45 days. And you pick that. Could be 2 weeks,
Okay.
could be 45 days. You could put 2 months out there. If you put 2 months out there, you're giving them more time for it to get to 110. So you get a little bit more premium, but it's not exponential. It's not like you get $2 if you offer to them for 2 weeks, and you get $4 if you offer to them for 4 weeks.
Okay.
Actually, you get about $3 if you offer to them for 4 weeks, 2 plus 1. Then if you offer them for 45 days, 2 months, you might get $5, So you pick the time, you pick the strike price, 110, you pick the strike date, 30 days from now.
Okay.
Or on the other end, when I'm buying a long-term leap, they're offering a 2-year leap.
Okay, so let me be a little crazy here and see if I understand this concept. So we've got our leap, and it's at $100. Again, we got to get to about 103 to make a profit on it, ballpark.
Right.
We then write a call at 110, so we get a premium on that.
Right.
Doesn't go to 110, we keep the premium.
Right.
We made money on it. Let's say we want to let it go. It goes to 110. We got the premium. We sell them the stock at 110 and simultaneously buy it for 80, but we already spent the $23. So
Right.
essentially the profit on the stock is about $7.
Right.
I can't believe I understood
Oh,
that.
you got that. You got that. Now, when we talk about making a call on a leap, this is what we're talking about doing. You own this stock now, even though it's a leap. You own it just as though it were a full share of stock. So you can place a call on this. You pick the date, the strike date. You pick the strike price, and I'm going to show you how you do that. So we've got NEO here. I'm going to clear everything off here. Hit the clear button, and I'm going to go out. It is July 12th, so let's go out to July 30th, 18 days out. And I could actually offer to sell this to somebody for current price, right here where the line is. That's where the in the money is, right there. And we know that because it's $46.34, and it's right there. So I could offer to sell it to somebody for $47, and they would give me a $2.15 premium. If I offer to sell it to them at $50, now I'm taking more of the profit, because 50 minus 46, I'd make about $4 times 100, $400 in profit. They get the chance to buy it if it goes over 50 by July 30th. Now they paid me $1.37 for that opportunity to be able to purchase this above 50, so you'd have to add $1.37 to 50, and they really would need to be at 51.37 to start making profit and be in the money. Anything does not make it profitable for them, but they do get some of their premium back. My hope is to keep it somewhere in this range right here. Now this year I've only had about 4 different companies that I had to actually make a deal, either buy it back or sell my stock to them. And that's done by making sure that this is far enough out of the money. So I'm going to change this from the delta to the out of the money. And I like to usually go about 80% out of the money. So I'm going to move it down to 80%. My strike price will be $52 in the next 18 days. And somebody, I'm making an offer. It needs to be somewhere between 91 and 95 most of the time. It doesn't have to be. You can put it out there for 88 cents. You can put it out there for $1. But what I'm trying to do is get the most amount I can. So I could do a 95. I could go higher than that. What they're saying is it's 93s in between. You'll find when you do this enough, this is an auction. There's a bid and an ask at all times. You can always try to get 95 out of it. If it doesn't go and nobody takes your offer, then go back in there and change your order. Change it to 94, and then 93, and then 92 if you need to. It's up to you at how much you're willing to let your stock go at $52 when it's currently 46. And remember, this is how you make a call on a leap or a full share of stock. And you can change your date out here. Today's the 12th. Let's say I only want this offer to be out there till the 15th. You can change that right there. Then hit review and send, and it'll tell you how much of a credit you're going to get for this one share on 52. I've got 6 calls that are finishing up on Friday, July 16th, in 4 days. And I want to go ahead and move it out to July 30th. That's called rolling a call. So what I could do here is I'm going to edit the order, show you how I did that. I took the July 16th and I bought those 55s back at somewhere between 5 and 6 cents. And then I rolled it after I bought out of my obligation. I rolled it to July 30th. And I collected somewhere between 53 and 55. Now remember, I have to subtract this from this. So if I subtract 6 cents from 55, that's 49. Or 5 cents from 53, that's 48. So right now they're saying the in-between price was 48. I offered 50. I said I would go ahead and offer it out there to somebody. If somebody wants, I'm going to sell this opportunity to buy my stock at 55, even though it's currently at 46. And at 55, right now it's saying the out of the money is 89%. So there's an 89% chance that it will never hit the 55 by July 30th, which is 18 days out. So you go and hit send. It tells you what your credit would be minus your, remember there's 6 of these here. My credit's $300, but this I have to pay the brokerage fee up front, which is $1 for each option. So $1 for every 100. I'm rolling 6 of them, 6 contracts. So it's 6 contracts would cost me $6. So instead of 300, it should be 294. But then you say, well, why is it 292.36? That's because the SEC gets their piece of the pie. The government gets the broker gets the $6, and then the other $1.50, actually $1.64, goes to the SEC. So it's not exactly $1 that the SEC takes, that the brokerage takes, but they take $1, the brokerage takes $1, and then the SEC.
If say that stock shot up to, in 3 weeks, it went up to $130 a share, you could sell it at that point for a $7 profit.
That is correct.
Okay.
To a point.
To a point.
The extra point that when you actually bought that for 103, the online brokerage kind of gives you a little bit of credit for owning that product. So you're not really paying the full $3. It looks like you paid 103, but really what you paid was 102. The guy on the other side maybe got 102, and you paid 103.
Okay. I think I kind of understand the concept. We didn't buy the stock. We bought a long-term option is really what we did. It's a stock that's at 100.
Paid a little more.
We bought the right to
Yep.
buy it at 80, but we paid $23 for it. So it has to go roughly to 103 or more for us to even to show anything on it. And how far out is this option written? How?
Usually you pick that. Whether you want to, when you're actually purchasing the Leap on your online platform, they'll have 1 month, 2 months, then it might drop out to 5 and 6 months, and then it might jump out to a year and a half, 2 years, maybe 2.5 years or 3 years. You pick which one you want to do. And the longer out that you pick it, the less of that percentage of a premium you're paying, because you've really spread out the risk for the person on the other side. And you've got an SEC fee. So you actually earned $292 on this deal. And if I do this, because I'm rolling this a little early, if I do this, my profit from the call that was going to end on July 16th that I'm trying to end now early, I'll make a profit of $453 on this call. The name of the game is to earn a little bit every 2 weeks, every 4 weeks, and nickel and dime this thing. And hopefully, by the time you settled up at the end of the year, of course you can monitor it daily, but at the end of the year, you want to be somewhere between 15 and 25% return on your investment. Well, that is how you roll a call that you have on a Leap. We purchased a Leap, we bought the calls, we made some money, made the premiums, and we rolled those premiums a few times. In this case, we own this particular Leap for almost 2 years. We keep doing that every 2 or 3 weeks. We keep making on six shares, make anywhere between $453 and $300 every 18 days, 21 days. It adds up, and it's not long where you've got your stock covered. Hopefully, if you can, make a good 20-25% every year while you have that and you own it for 2 years, there's no issue with making 40% on an investment over a 2-year period. So that's how you do Leaps. We bought, we called, we rolled that call, we sold the Leap. We own this particular Leap for almost 2 years. We keep doing that every 2 or 3 weeks. We keep making on six shares, make anywhere between $453 and $300 every 18 days, 21 days. It adds up, and it's not long where you've got your stock covered. Hopefully, if you can, make a good 20-25% every year while you have that and you own it for 2 years, there's no issue with making 40% on an investment over a 2-year period. So that's how you do leaps. We bought, we called, we rolled that call, we sold the leap. That's good.
Whoop.
Part of the reason
I know you're talking
Part of the
like,
reason I'm breathing so heavy, folks, is I know you all know that I have congestive heart failure, but my cardiologist says I've got to go out and walk 30 to 45 minutes a day.
actually, he's just excited being around.
Oh yeah, I like being around Pat, so I'll lose my breath. But
Sorry, I'll vomit. Go ahead.
yeah, it's too bad. But you know, if I wanted to jog, I could actually kill myself here in the next quarter mile. If I really wanted to just leave Earth at this point. So my heart now, your heart's probably only running about 72 because you're in such great shape. My heart's probably running around about 120 right now.
Right. Well, and you're talking at the same time.
Yeah, but I also have heart medication that slows my heart rate down because I have atrial fibrillation too. Makes it really hard to work at Best Buy and walk the store. That's why I had to retire. I'd get to walking around the store and customers would say, "Are you okay?" And I said, "Well, I was in the back of the warehouse when you guys called for me, and I had to run up here, and I'm just not.
Well,
the heart's not able to move that fast."
You know, if you did collapse during this interview, we could call it stock till you drop.
Stock till you drop. Yeah, yeah. Part of the reason why I like to do stocks, and the way I love to teach people, because if I'm sitting behind a computer, I'm not actually walking and talking and trying to talk to customers like I did with my career. Even when I supervised 150 stores, I still had to, all the way from Florida up through Texas, I had 150 stores, and every night I was changing hotels and packing up the luggage. Well, after I had my 5 bypass and realized that I had issues, it was real evident that you have to be careful with a heart, because it's your engine,
right?
And mine is about a third bigger than what it should be due to being stretched out. But let's go ahead and start walking again. We'll finish up the topic here on leaps, because we want to talk about where the risk is at, because we've talked all good stuff so far.
Well, and now as we go into that, the control part, if I looked like I understood it, well, again, that's my fine acting skills.
Okay.
You see,
Well, let's say it again, because I think it's a really key point to take on, because when you're buying this leap, you've got to ask yourself, how much control do I want to have of this? And on the other end, if it goes south on you and it goes less than $100, you've got to pay that 50% back if you end up selling it on a call.
Okay.
Because you have to give them a full share of stock.
So that concept that I threw out originally, which was the simple concept,
Right.
to where we sold it for, what did we say, 110? Was it originally? I forget what the number
Yeah,
was.
we bought it for 100. The stock was 100. We bought it for 103. And then the point was it went over 110, which was our call.
Right.
And so let's say it went to 113, like your example said. What happens with that leap? Let's go ahead. Tell me what happens.
So that's where I get thoroughly confused, because
All right. Let's say it's 50% delta. You bought it for 30% of the total stock. That $100 stock you bought for 30. Are you going to collect the whole $7?
Now let's see. That's where I'm getting lost up front.
Right.
So I bought it for 30%.
Right.
What does that mean per se?
Yeah, that's
So
your delta.
is that how much? Is that how much I paid for the leap?
Yeah. Yeah.
So if we did it at $100 stock,
Yeah.
and I paid $30 for the leap, does that mean that I have 30% control of the stock, or what is that? See, that's
It
where
actually works out to about 50%. Okay.
Okay.
And it's different for every stock. That's why you got to look at them and calculate how much, because they'll tell you on the online broker, they'll tell you what your control is. It'll be over there, and you just type in delta. The delta comes down and says, okay, I can get a 50% delta, which means that I can control 50% of this stock, but only have to pay 30% of the total stock.
So that's the pricing of it. That's where the pricing of
the pricing.
So depending on where that's at is how much you're going to pay for the stock. And then what you're saying is that if it's a 50%, that means whatever profit you make, you get to keep 50% of it.
Of the stock price, yes.
Of the stock price. Where does that other 50? Does that go to the guy who
Goes to
bought
the guy
it?
who bought it from. Yeah.
Oh,
the other side of the
okay.
table. There's
Okay.
always a buyer and a seller.
Okay.
So you're only buying percent delta. I want to control 90%. That's as high as they'll go. The other side wants to keep 10% of the total. But I usually pay between 40 and 60%. Let's call it 50%.
Okay.
And sometimes I get it cheaper than that. Depends on the company, the stock, and on how much volatility there is. There's a lot going into the pricing of it. You can't really control that.
Right.
You just need to know by looking at the volatility index and knowing the company and what their trends have been, whether that's a good price.
Okay.
And I usually get them for between 40 and 60% when I have 90% control. So what I mentioned a few minutes ago was, Pat, what happens when you go to settle up and that thing went to 113? So now you got to let your leap go. You got to give the other fella who bought your call, you got to give him 100 shares at $110.
Right.
Okay? So how do you think that settles up on your profits? That's not an easy question. I get
No, it's not, because you have to now, you're essentially buying that stock at 80, right? But you paid 23 for it, plus there's also the fact that you don't get to keep all of the profit.
Right.
So
Perfect. Right.
again,
So-
so
your
I did not
analogy-
realize there was going to be math. Go ahead.
Yeah, really, math as we were walking.
That's right.
So your analogy of, well, you're going to end up clearing $7 on the stock is not exactly true. You're going to get 90% of $7.
Got it. Okay. So in layman's term, if I've got, let's just say, a 50% control on that, I get to keep, out of the $7, I get to keep $3.50.
Right.
If it's a 90%, well, then that's six.
Right. Now we're going real math here.
I think that's $6.30. I don't know. That's why they have
That's
calculators
63
and
cents, right?
computers, right?
63 cents off of 7. So yeah, that would
That's
be
right.
$6.37. Correct. You got it. And that's why it's really nice when you use an online broker, because you can say, hey, I want to close that call and I'm going to close that leap maybe 2 years out.
Okay.
You go over and you hit send, and it comes up with how much you make if they accept this bid to get out of your obligation.
So,
It's sweet.
but that's not a often occurrence. Your real
Right.
goal there is to write the call against the leap and collect
And
the
never have
premium
it hit.
and never have it hit, and then go back and do it again. So
Right.
the biggest risk, I'm guessing, on that is we went and we got the opportunity to buy that at $80, and it was at 100 at the time. And then what
And I
happens
paid
is
23 more
we
on
paid
top of that.
23 on top of it.
Yeah.
And a year later, it's worth $60.
There's a problem.
Right. Okay.
Yeah. Houston, we have a problem. And there's two parts to this. Let's say it's worth $60 and you had 90% control. How much do you think that leap is worth after a year at $60?
Again,
It dropped
yeah.
40%
Right.
from 100 to 60.
So, God, I mean, you're big time negative, right?
Yeah, you're about $6 on a share, right?
Yeah,
40%. So it's worth about $6. Plus, you still have a little bit of time value in there that the other person is, sucking out of you for those 2 years.
Right.
So maybe, and time value drops off in the last few weeks when you get to the end of the contract. So you might think, well, I'm only got half the time value. I paid him $3. I'm sure it's, I've got $1.50 back so far. No, probably you're lucky if you've gotten 50 cents back.
Now, this is one that, we put down on a piece of paper.
Yeah.
So I can write it out instead
So
of
you
just
can
doing
see
this
it.
while we're walking.
Just
Yeah.
understand the concept is that if it goes down, you're responsible for 90% of that loss. So when it went
Got
down
it.
40%, you actually have to tack on another 10% of the original $100, right? Because you only control 90%. When it goes down, it really goes down, and a leap will lose value quickly when it loses that much value
Okay.
in 1 year.
So it
that's
sounds
why
like-
it's risky.
So it sounds like it could be a powerful tool, but it can come back and bite you.
Right. Think of it as margin. You are leveraging yourself to buy more stock with less money. So there's risk to that. Okay?
So
if it goes up, then you get to keep 90% of all the profit going up. Hey, everybody loves that, right?
Right.
But anybody can make money in a market that goes up all the time.
Right. And
When
it's
you
not
got
gonna do
going
that.
down, you got to cover that. So how would you cover? That one might be an extreme example because I don't know that you can make 40% in a year, but I normally make about 25% in a year. How could you cover $75? You know, if it went down 25%, how can I make 25% to cover that? Well, that's where you do your premiums.
Right. Got it.
If you do your calls, and I run a little spreadsheet, and I show it on the Trading for Rich channel. I run a spreadsheet that I update every 2 weeks, and I kind of calculate how many calls and puts I've done, and what kind of, I call it cash flow, because this is a store.
Right.
I paid so much
It's
for the
an
inventory.
active business. You're not just sitting on it.
It's an active business. Now, going back a few seconds ago, how often do I really hit, you might ask? How
That's a
often
good
do you
question.
actually hit those call points? You know, you set it at 110. How often does that happen? This year, 2021, you know, I've done probably at this point, because I'm averaging about 500 to 700 trades a month. I've hit that call point, and usually it's with the same stock in different accounts. I've hit it less than 1%. So I up and through May, I had none. I went from January to May without having any of them hit their call points.
Are you being
Their strike
conservative
points.
to make that happen?
Yes,
or-
I am.
Okay.
I'm putting that strike out there quite a ways. There's a way to price your strike so that you can kind of use the algorithms that Tastyworks has put together. It's called Out of the Money. What's the chances that this will be out of the money by the time it gets to the date I'm picking? They'll actually tell you that through the algorithm. And I usually pick about 85 to 90%. Now, if I had chosen a smaller out of the money, like 50%, then I'd be hitting that more often.
Okay. And
But
so
when you hit it, I don't want to pay the difference between the leap price and the full share price when I have to, you know, produce that stock, because I have an obligation to produce that stock to the person who bought it from me.
So now, and I always get this confused. Out of the money means that at that point you've exceeded the strike price, or it's
No.
the other way around?
No, out of the money means what are the chances that I'm going to get to that price?
Oh, okay. So out of the when you're out of the money, you haven't made any money on it. Is that
Right.
correct?
So it's $100, and $110 might be 90% out of the money. It might be 67% out of the money.
Okay.
But they'll tell you that. And what they're doing is they're looking at pricing trends for that stock and the volatility of, you know, the expected move, whether, and we'll do another video on expected moves because it's pretty intriguing how they price these premiums. But out of the money means that, I'm gonna go around one more.
If you're up to it.
I might have to stop and breathe again, but
Well, here, you want to take a break for a minute?
sorry, we can just slow down for a second here. Okay, we're cutting for break.
We need to get a hat